I'm Hitesh Jadda, and I'm pleased to welcome you all to this conference call to discuss Q1 FY 2019 results. Our results material have been uploaded on our website, and you may like to download it and refer it during our discussion. The discussion today may include some forward-looking statements, and these must be viewed in conjunction with the risks that our businesses face. On the call today, we have with us our Chairman, Mr. Ajay Piramal, Mr. Vijay Shah, Executive Director, Nandini Piramal, Executive Director, Piramal Enterprises, and Mr. Khushbu Jijina, Managing Director of our Financial Services business. With that, I would like to hand it over to our Chairman and would request him to share his initial thoughts. Over to you, sir.
Welcome to our investor call. I'm pleased to announce another quarter of robust performance by our company. For the first quarter of the current year 2019, the company has delivered a 29% growth in revenues at rupees 2,902 crores, and during the quarter, we sold the imaging business to Alliance Medical Group. Upon the sale of this business, there was a non-recurring and non-cash accounting charge of rupees 452 crores towards imaging assets, and hence the company reported a net loss of 70 crores. Excluding this charge, the adjusted net profit for the quarter is rupees 382 crores, an increase of 27% as compared with 302 crores in the same quarter of 2018. On account of the synergies from merger of subsidiaries in financial services, the cash profit for the quarter grew even higher by 54% to rupees 540 crores. During this quarter, all our businesses have demonstrated a strong growth performance. Financial services in detail. During the quarter, our loan book grew by 64% to rupees 46,995 crores. In addition to this, loans worth rupees 22,400 crores are approved but yet to get dispersed. So, in all, loans worth rupees 69,000 crores are either dispersed or about to get dispersed soon. We also saw strong growth across all the verticals of financial services: real estate, developer financing, corporate finance lending, emerging corporate lending, and the housing finance business. The real estate loan book grew by 40% to rupees 34,800 crores, and the corporate finance loan book grew by 163% to 9,400 crores. The new verticals which were launched in the last year are also witnessing a strong performance. The sector agnostic emerging corporate lending vertical grew to rupees 1,163 crores, and the housing finance vertical grew to rupees 1,604 crores. Additionally, the business has loans approved but yet to be dispersed of 1,087 crores as on 30th June 2018. We have been consistently maintaining a healthy asset quality with the gross NPA below 1% since the last 10 quarters. At the end of the first quarter ending June 2018, our gross NPAs ratio based on a 90-day DPD remains healthy at 0.3%. Being more conservative, we continue to provide much more than the regulatory requirements and maintain our provisioning at around 1.8%. Risk is the most important as far as the board is concerned, and to further strengthen our focus on risk, we now have a risk management committee of financial services. This includes people who have a lot of experience in financial services, such as Mr. Vagul, Mr. Deepak Satwalekar, Mr. Bobby Mehta, and also an external advisor in Mr. Deven Sharma, who was the former president of the Standard & Poor's USA. Post the merger in the first quarter of this year, the long-term debt instruments of Piramal Capital and Housing Finance Company were rated CARE AA+ stable, and it is an upgrade from their earlier rating of CARE AA stable. The company has recorded a ROE of 25% plus over the last 10 consecutive quarters prior to the fundraise through the QIP and the rights issue. As you are aware, we raised nearly 7,000 crores through the QIP and rights issue. And during this quarter, the business generated an ROE of 19%, taking into account cash tax and other synergies from merger that we completed under our financial services business a few months back. The ROE, as reported in this quarter, is lower than that of the earlier quarters, only because we have allocated 5,000 crores as equity which was raised to the financial services business on 31st March. In the long term, we expect to deliver 20% plus ROE on a sustained basis. On the pharma side, global pharma revenues grew at 16% to 979 crores as compared to 845 crores in the first quarter, on account of a strong growth in API development, stable performance of inhalation anesthesia, strong volume growth of vitamins and premixes. Our differentiated business model has ensured that we perform better than most of the other Indian pharma companies who have been impacted by regulatory issues and generic pricing pressure. We remain focused on quality, and whereas it is an ongoing issue for many Indian and global pharma companies, with a large number of them facing scrutiny by regulatory authorities such as the US FDA, our company has cleared 5 regulatory inspections, including an US FDA inspection in this quarter and 51 customer audits. Since 2011, we have successfully cleared 138 regulatory inspections and 877 customer audits. The Indian consumer products business saw a strong recovery in the top-line performance as revenue grew by 55% year-on-year to rupees 64 crores. This improved performance was on account of launch of new line extensions, investment in digital assets, and scaling up of the e-commerce and the lower base of last year. The healthcare insights and analytics business revenue grew by 10.5% to rupees 278 crores, primarily driven by our continuing focus on data and analytics business, and out of this, 4% was because of the depreciation of the rupee. The India expansion continues in Bengaluru and Gurugram offices. It has now onboarded a total of 400 employees out of the total of 1,200 at DRG. These are the highlights that I wanted to touch upon the quarter. I would now like to ask Mr. Khushru Jijina to take you through the performance of the financial services business vertical in more detail.
Good evening, everyone. Khushru Jijina here. I think I'll start with the number which Chairman just mentioned, that our loan book in financial services grew by 64%. That is, we ended up the quarter with 46,995, so roughly 47,000 crore. Now, where did this growth come from? I think it's what I would like to touch upon. And we will also touch upon this same point when we go into each verticals of financial services. We have been saying that for the last few quarters, in fact from the last year or so, that when we integrated the corporate finance group into our vertical, that we feel that the CFG will actually grow the fastest. And as Chairman rightly said, in fact, even in this quarter, if you see compared to the last year, the CFG has actually grown the fastest. Of course, the growth was also fueled by two new businesses, which is emerging corporate lending and housing finance, which I will talk in detail. Again, there is a growth in the real estate, not to say so, because that is the bulk of our business as of today. But again, if one really dissects the business in the real estate wholesale segment of financing, again, where are we growing? I think if you really do a granular deep dive, you will see that the growth is again coming mainly from construction finance and also the hospitality sector which we entered. So that's where the growth actually came from. So even if you look at what's really happening in terms of diversification, we have been talking about granularity and diversification. Today, when we started off with this new verticals, last year, our real estate wholesale was 87% of the book. Today, it is down to 74% of the book. And we continue to maintain that as a percentage to the overall book, it will continue to come down. Chairman mentioned about the NPA. Yes, we continue to have a gross NPA of 0.3%, and it has been below 1% for the last 10 consecutive quarters. The other very important data point for this quarter was that we disbursed 8,800 crores, and out of which the repayment and prepayments were 4,200 crores, which is actually 48% of the disbursals. Let me also go into a little more granular details of the repayment prepayments. Again, more than 50% of the prepayments and repayments actually came from the cash flows of the project, and the others were refinancing. Again, in the refinancing, let me clarify that the major refinancing was not because the project was not doing well and it shifted to something else or some other lender. It was basically that if I had underwritten, say, a structured finance loan and our assumption that it will be taken over by a bank or somebody else when the project becomes much less risky, that has actually played out. So that's the point I want to make. So not necessarily that refinance is, if somebody refinances me, is a bad word, because as long as the thesis has played out, it is fine. So that's the point I want to make. And again, this is not something unique. We have been saying this for the last 3 years, that more than 35 to 40% of the book is getting churned. So it's actually a very good thing. It again shows that our underwriting, the thesis which we follow, is going right. As Chairman mentioned, that over and above the AUM, we have 22,400 crores of sanctions but not yet disbursed. Let me give you a feel of what these sanctions are. Again, majority of the sanctions are nothing but construction finance which have been sanctioned in the last 1 year or more or so, because as you know, the payment to the developer is done slab-wise. So obviously, this will get disbursed in a particular time or so. Also, this includes various other deals. Not necessarily it could be only real estate. It could be in the CFG part. It could be where the IC has just taken place. We have sanctioned the deals. Housing finance, for example, Chairman mentioned a number of almost 1,100 crores, ECL and other businesses. So I thought I'd just clarify what this number stands for. Yes, our ROE, even after the receiving capital of 5,000 crores, has been at 19% on a cash tax basis, and today our debt equity ratio is down to 3.9x. Though in the long term we have given a guideline that by 2020 we will go back to 4.5, 5 times. Rating, I think I mentioned this last time that we expect a very positive feedback from the rating agency after our reverse merger, which has actually played out. So immediately after our reverse merger, between the wholesale and the retail, the CARE has now assigned a long-term rating of CARE AA+, which has immediately brought down our borrowing by 25 to 30 basis points, the impact of which will actually play out in the next quarter. Again, just to re-emphasize the rating rationale for it, it's not only the merger. I think it recognizes the strong performance across all our verticals, whether it's real estate or non-real estate. and is also validation of our efforts towards diversifying our loan book and the risk management, which has been tested not only by the Reserve Bank of India but by the rating agencies. Let me move on to the vertical of real estate financing, the wholesale part. As we have always been speaking, so let me start by what is happening in the real estate industry. I've been saying this for the last few quarters that the consolidation is on, and we actually see it quarter on quarter, the consolidation actually playing out more and more, because thanks to the introduction of RERA, GST, demonetization, and we keep on seeing this consolidation happening in the real estate industry. In fact, I'm happy to say that even with the three tsunamis which the industry has gone through, our portfolio has not just withstood the impact but actually performed better due to this regulatory changes on the back of deep relationship with the developers. So one is, of course, the relationship cutting across the entire capital stack today, which we are able to provide, the risk management and the monitoring processes. And I've always mentioned that not to be taken lightly, the underwriting processes which we have. In fact, today I think I'm going to share some data points with you. We have been saying, if you recollect in the past, that we work with very select developers. Last 3 years we have been saying that ultimately few developers who have imbibed new technology, who have imbibed new ways. In fact, as we say that the traditional way of real estate is dead of doing business, is actually the FMCG way, which will only make the developers survive. And we have been saying this for long, not a quarter or two back. We have been actually saying this for the last 2 years. So we actually did a deep dive to find out that what is the percentage of market we are serving and what's really happening to those developers. Because if you recollect, even last time I did mention that from January to March, for the first time we saw our developers selling, their sales were as good as pre-demonetization days. But the market continues to reel under tremendous pressure of oversupply, price corrections, etc., etc. Then how is it that we are doing well? How is it that we are getting repaid? So just to share the numbers with you, in the cities where we are, there are around roughly 10,500 developers and 21,000 projects back up. And our portfolio actually comprises only of 1.3% of the developers in market. So what I mean is that our loan book in real estate of 34,600 crore is actually serving a very small group of developers, the developers who have moved on from the traditional methods which we spoke about or we speak about all the time, and are actually got into the new method of, that is, financial closure from day one. Because after RERA you need financial closure. After RERA you need execution capability. You have to actually work like an FMCG, as I always say that. So we are only serving 1.3% of them. And we wanted to know what is the percent of sales of these developers. So actually our portfolio of 1.3% contributed to 6.7% of the sales across India in the past 6 months, which validates our selection of superior projects vis-a-vis that available in the market. Let me give some more granular details. In the two large markets, which is MMR and NCR, in MMR we are only 1.6% of the projects today which are ongoing, which contributes to more than 9% of the overall MMR sales. And NCR is far more interesting. We have funded only 1.7% of the projects, contributing to 17% of the overall sales. And Noida is 3.4% of the projects, contributing to 39% of the sales in the micro. So what does it mean really? All the points which we have been saying for the last few quarters, that we are selecting, ultimately lies in the underwriting and selecting the right developer and the right project, is actually playing out. Let us also test this thesis on the number of months supply overhang. So let us again look at MMR and NCR. Today in MMR, the inventory overhang is at 40 months, is 58 months, sorry, and our projects are at 40 months. Within NCR, Gurgaon inventory overhang is 65 months, and ours is only 39 months, our projects. And Noida, from 80 months, ours is only 42 months. So, needless to say, this performance is truly a proof of the rigor that we take in our underwriting, which is backed by, it is not backed by any desktop research, but on the ground knowledge, which we have been talking about. But I think this data proves beyond doubt that we are really selecting a very few set of developers whom we believe the 90-10 which we speak about. In fact, it is not even 90-10. It is a very small set of developers whom we are backing, and they are actually doing better. Let us talk about our loan book. As Chairman mentioned that our loan book grew by 40%. Again, I have already mentioned that you have to look at the 40% with what happened within the portfolio. Let us look at what has happened in terms of percentage to the high-yield mezzanine loans. Today, I'm happy to say, and we have been saying this as a guidance, that our main today is construction finance, and we are moving towards LRD and also to construction finance for commercial. Again, our LRD, which was 35% a year back, has mezzanine loans as a percentage to our loan book in real estate has actually come down to 25%. And construction finance has increased to 62%, which was 60% in Q1 of FY 2018 and 49% in Q1 of 2017. Our commercial real estate book, which is basically office space, construction finance, has increased to 22% in this first quarter from 12% last year. And basically the in absolute terms has increased from 3,000 crores to 7,500 crores. Again, the LRD book, which is really going granular, has increased from 1,250 to 1,250 crores to 4,300 crores. Again, a jump of 250%. And in the hospitality sector, which we just recently have entered, basically again mainly in the form of LRD, means basically revenue discounting of operational, more than 3 to 5 years operational assets across the country, we have disbursed 1,340 crores, and we have actually a very healthy pipeline there. If I move to corporate finance group, which is basically the non-real estate financing, that's where the loan book really grew to 163%. That is to 9,414 crores. Again, here, very important data point is the mezzanine funding. We started off doing mezzanine funding, which is high risk but high yield, and we have been giving guidance that we will move exactly like what we did in real estate. While we will go down the risk curve, but on a risk-adjusted return, we will still be getting a good return. We have actually done it. Just to give you a number, within 18 months today, our mezzanine funding is down to 51% of the corporate finance group, and the balance is senior debt and loan against shares and project finance. We have moved away not only from mezzanine funding, we have also moved into other sectors. That is from renewables and infrastructure. We have also moved into cement and logistics and warehousing, etc. ECL, Chairman mentioned about emerging corporate lending. Again, the growth there has been 8 times. Of course, the numbers are smaller, but that is where this is what is giving us the granularity which we have been speaking about. It has the book is now 1,163 crores against 140 crores last year, and that is where we are really ramping up. We are actually ramping up the team. The team has now become 21 people strong across all, whether it's investment, it's asset monitoring, it's risk, legal, etc. Let me talk about housing finance vertical, which we launched on the 4th of September 2017. I think within this less than a year, today our housing finance loan book has grown to 1,604 crores. And more importantly, I'm very happy to share with you that we disbursed 384 crores in the last quarter. What does it mean really? Is that when you look at 1,600 crores, though today we are into 6 cities and 7 branches, mainly the bulk came from the Mumbai region, because the other centers, whether it was NCR, the 3 regions in NCR, whether it was Bangalore, whether it was Pune, all were launched between between March and April. So the real AUM has really come from Mumbai. And that is why I'm sharing with you the last quarter, because that is what we are monitoring, and we do see the uptick month-on-month disbursement, because now the other regions are also able to give us the throughput. So that has been a very, I would say, a heartening number for us. And even the customer mix of 54% salary and 46% self-employed is very good. Again, 87% of the whole loans are actually below 1 crore. So as I said, being in Mumbai, basically Mumbai biased as of now, hopefully in the next few quarters, you will actually see a diversification in terms of regions also, in terms of cities. But even being mainly right now in Mumbai and a ticket size of below 1 crore is actually a very good number to have. What are we doing on the underwriting? Because that's something which we have, it's a constantly, risk and underwriting is something which we have to look at an ongoing basis. It's not something that is static. So let me again give you an insight of what we are doing. Recently, we went through an entire exercise along with risk and asset monitoring. I can just share that with you, of reclassifying who are tier 1 and tier 2 developers. You know, this whole concept of tier 1, tier 2, which is being very loosely spoken about. Tier 1, a large developer, etc., and tier 2 could be smaller. So we have really looked at it very differently recently to reclassify them and relook at the opportunities, or if you have to get out in any of the developers. So again, just to share some of the nuances, not all obviously, like since now we have the data points of the last 3 to 4 years, like for example, the ability to sell in such a difficult market, we looked through that. Whether these developers have been continuously executing on the site. We also looked at the team, minimum key man risk, etc. Very interestingly, you know, we have been speaking about early warning signals. I'm sure most of the people on the call know that we speak about it all the time, one of the strengths we have. I'm also very happy to share with you that we have also developed a proprietary model of early warning signal in our housing finance, which is again very unique to housing finance, because it is these processes, it is this underwriting, it is this early warning signal which differentiates us from the rest. I always said that the growth is a byproduct of all these quality things which we do. So I'm sharing this with you in this quarter. We actually have developed a very robust and a very different proprietary EWS mechanism for IHS. I also want to touch about on the asset liability match in the borrowing mix. We just mentioned about CARE, so I don't want to repeat that. I also mentioned that it has immediately benefited us in our cost of funds. What is happening to our ALM? So as on June 30th, our asset liabilities are, again, I want to mention, are well matched. 45% of our floating assets are against 43% of our floating rate liabilities. So it's absolutely well. Also, the balance fixed portion is linked to our PLR. So what do I mean? Because a lot of questions keep on being raised. You know, people think that in a rising interest scenario, what happens? So here, I wanted to make this statement that, as I said, almost half of our portfolio is floating, and the other half, which is fixed, is also linked to the Piramal PLR. So it means that at the most, on the 50% portfolio, there is a lag effect of maximum a quarter. So we are absolutely well hedged. That's the statement I wanted to make. Over and above that, in terms of liquidity today, we have adequate cash surpluses and unutilized bank lines, and which are confirmed committed lines which are maintained at all times. So today, on a prudent basis, we not only keep cash surplus, we also keep unutilized lines at any given point of time. I had mentioned in the last call that once the merger happens between the wholesale and the retail, there are a lot of things which will play out. Of course, the benefits of consolidation, etc. But one point I had also spoken about, one was, of course, the rate, and then it also opens the vistas to various other borrowing mechanisms, that is ECBs and masala bonds, etc. So we have started looking at that. So I just thought I'll share with you. So to end, priorities going forward. So I think in terms of the loan book, we will continue to concentrate on diversification. These two key words you will keep on hearing from us, which is diversification and granularity. And I think we are definitely going to keep on doing that. We see a very good opportunity in continuing to do the financing in the real estate wholesale side, as I've already demonstrated the numbers, and now with the entire capital stack, right from equity to housing finance. In fact, in the next 2 months, you will hear us announcing a few equity deals on the Ivanhoe platform also. So that is giving an end-to-end solution to a developer, and having chosen the right partner developers, I think it's a good time to continue the growth into this sector. We will, needless to say, continue to strengthen the risk monitoring and the asset monitoring without a doubt. I think the other very important thing which we have not touched upon, but I would like to give just touch upon it, is the technology. I think at the end of the day, whether it's housing finance or wholesale, technology has to be used because of the disruption. And we have started using in the last 6 months a lot of technology, not only in bringing the turnaround time down in housing finance, and that's showing in the numbers. One of the reasons why housing finance is doing, it's not only the relationships with the wholesale, it's also with the service, the turnaround time, and the analytics. We now have a full-fledged analytics cell which works. It's, according to me, a third eye, which actually works with not only the housing finance but also the asset monitoring, the risk on the wholesale side, which is bringing another unique opportunity, or I would say an advantage to our platform to see things much, much earlier. And needless to say, our end game is ultimately the rating. We will keep on moving and focusing on getting a better rating, because at the end of the day, by getting a better rating, basically what are we saying? We are saying that we are a much better book, we get much lower cost of funds. Last time I touched upon the new businesses. Let me share with you all what we are doing. One was the asset aggregation strategy into roads and the operating roads and renewables. We have already started identifying some few team members. We are hiring a few of them. We have applied to SEBI for the AIF, and we have already started talking to a few sovereign funds for that. Hopefully in the next few months, in this financial year, we should be announcing the setup of that. We spoke about the aggregate REIT platform. I think that's also in the works. I think by March 19, we should be ready to launch that. Means all the works, I would say the company would be in place. We also spoke about last time the syndication, the focus on fee-based income. Apart from these two which I spoke about, we are going to concentrate. We have actually started hiring more people into the syndication desk. You will hear from us more and more. In fact, in the first quarter itself, the syndication team gave us a small but is a good beginning of 9 crores fee income. But that's something which we will concentrate on in the coming years. So with that, I think I will hand it over to Hitesh for any question answers.
Operator, we can go for Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Hardik Doshi from First Voyager. Please go ahead. Hardik Doshi from First Voyager, your line is unmuted. Please go ahead with your question.
Yeah, can you hear me?
Yes, sir. Thank you.
Yeah. So, firstly, just wanted to understand on the real estate side. I saw, I heard the metrics that you gave in terms of MMR and NCR and how your projects are doing a lot better. But at the same time, the feedback you get is also within these regions post GST and, post the RERA. A lot of the sales have been slow, especially in the high-end market, which is also where we will be lending to among the top 10 developers. So, I just want to understand how are you viewing the overall industry? I mean, do you think, this is a short-term structural problem for the industry overall? Is it a short-term liquidity problem, or is it a structural issue that's going to continue for a while?
No, so let me answer it. I think as I gave you the data, but even before giving the data, I've been saying this for the last 2 years, that the consolidation, what do I mean by consolidation? Means the customers are only going to developers. I'll come to your luxury in a minute. Are going to the developers who are able to execute and deliver. I think on the last call, I also made that state. I gave an example of Piramal Realty, who is incidentally not our client because of related party. But the example I gave of the launch of Piramal Realty of Piramal Mahalakshmi. Why did I give that example? Because it proved beyond doubt that if today you are a good brand, you give a good product and the right ticket size, it's all a combination of that. Demand is there. In Piramal Realty incidentally sold 2,500 crores in 15 days. that shows that the demand is there for very few select people and the right ticket size. Let me define right ticket size, not necessarily low ticket size in each micro market. So that we are actually seeing with the primary data in all our 380 projects which we monitor across India. It's the same theme playing out. So today, why I gave this data 1.3%? Because, as an outsider, you are very right in asking the question that how come you guys are doing well when we are seeing bloodbath in the market? And that's the point I'm making. You are seeing 98% of the market, which is basically not doing so well. The 90-10 statement which we keep on making. And that is why this will take some time for the market to filter. This filtration process, as I say, is going on, where the distressed developers are turning themselves into landlords. Incidentally, we are playing a major role in that, in the consolidation, by getting the distressed developers tied up or selling their assets to our developers. Talking specifically of luxury flats, just to give you a data point, more than 90% of our loans are in bid market. So we are not into luxury anyways. This luxury, luxury is not a bad word. Where did everyone go wrong? People went wrong because in just a few years ago, the market had become frothy and people were actually the developers, you'll be surprised to know, had started making flats for the investors and not the end users. And investors have started asking for bigger flats, and then people started making luxury flats with 200 luxury flats. You cannot have volumes and luxury together. I always give this example about Worli Seaface. If you make 10 flats in Worli Seaface for 100 crore each, trust me, they will sell. But if you make in any other location, even in a South Mumbai with 200 flats and sell it for 40-50 crores, it won't sell. And that's the point I'm making. But to just give you a direct answer, we are 90% actually in mid-market, so we are not affected.
Got it. The second question I had, which is more of a clarification, is that I think last quarter, your yield on loans was about 14.8, which now seems to have fallen to 13.9, but your NIMs have actually increased and so have your ROAs, but your cost of borrowing is also fairly stable. So just want to reconcile those differences on a sequential.
Please repeat your question once.
Sure. So last quarter, your in your presentation, the average yield on loans was 14.8%, which now seems to be at 13.9. And while your cost of borrowing, which was at 8.4, has gone to 8.5, but yet your NIMs have increased from 6.4 to 7.1, and your ROA has gone up from 3.1 to 3.6. So, can you just reconcile those numbers?
So in the last quarter, the yield which you saw were the average yield for the last financial year. This year, what you're seeing is the average yield for the April to June financial year. So they may not very clearly be comparable.
Actually, also the 3.1 number that we had reported last quarter wasn't correct, and when we had rectified, we had sent a note to the exchange saying that the number was actually 3.9. So what is comparable number is 3.9 for the last quarter is actually gone to 3.6.
Got it. Okay. And the NIM also, I guess the 6.4 is the average for the full year, which is now increased to 7.1. Is that correct?
Yeah, so 3.9 was also average for the full year.
Oh, okay.
For the last quarter.
Okay, got it. All right. And my last question is, on the CFG part, in the past we've spoken about how we build domain expertise in each industry prior to entering there. But, I'm just looking at the rate at which you're entering new industries. I think this time we entered into 3 new ones. Last quarter, I believe it was a similar number. So, just trying to understand how do you go about building domain expertise so quickly in, so many industries?
So that's a good question. So actually, let me share the way we work. It happens suddenly. It just happens of that few months of work has fructified. So let me tell you, for example, if you hear us now in the next few quarters talking about logistics and warehousing, it's not that we have discovered logistics and warehousing now. For the 9 months I've been speaking about, if you really go back to all my calls, last 9 months we are studying the sector, we have got the experts on board, we have gone deep, we have identified with whom we have to work, identified which are the areas where we'll bring value add, and then you suddenly see 3-4 deals being announced. If I'm making sense to you. So we first spend 6 to 9 months into each sector. We have a separate team which does that. And then we have got experts on board. So each deals are vetted by internal and external experts. And first we actually spend time understanding the industry. Means when we talk to the promoters of the industry, trust me, it is not a financer talking. We know the industry as much as the promoter. So that's our model.
Got it. Okay, thanks so much.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal. Please go ahead.
Hello.
Yeah, go ahead, Alpesh.
Yeah, hi. Good evening and congrats for the good set of numbers. First question is related to the financial services business. If I look at the segmental assets, the number is around 56,000 crores, whereas the loan book which is reported around 47,000 crores. So this 9,000 crores difference would that be primarily related to Shriram Group or?
Yeah, that's right. So the segmental results also include Shriram Group in that, and that is the reason you see the difference.
And the Shriram Group in the segmental results, is it at the cost or including the mark-to-market gains as well on that?
Yes, so it is at the market price.
Okay, so around 7,500 crores.
7,500, that's right.
And 1,300 crores would be the asset management related.
That's right. That's right.
So the mark-to-market is for the two listed companies.
Sure. Second question, if I look at your annual report, there are some loans and the loans which are not to the related party, but the external loans or the bonds which are standing on the standalone balance sheet. By when do you expect that to be transferred to the Piramal Housing and Capital?
Yeah. So, in fact, just to share with you, in fact, we have even committed to the regulator that this year we will be moving them to, and the process is already started.
And what would be the exact quantum of that? Would that be around 8,000-9,000 crores?
No, I think 7,300 crores.
Okay, and that would be transferred to the to the NBFC division.
Yes.
Okay. Again, it was very strong performance on the housing finance business. What would be the average ticket size and what percentage of that exposure would be towards the subvention kind of schemes?
So, I do not have a number on subvention schemes, but let me answer the first one. Today, our average is 80 lakhs. And you will appreciate that that's a good number. As I said, in fact, this number will keep on coming down now with the AUMs coming from the smaller cities like Pune, Noida, Bangalore, etc. But today, even in Mumbai, as you will appreciate that Mumbai, normally the flat size are even the smaller are 60 to 80 lakhs. So 80 lakhs is the number for you. And we are constantly seeing the number actually coming down. Coming to the subvention scheme, while I don't have a number, let me answer it differently. Today, it is a mix of everything. The fact that, I wouldn't have the number really. Probably, if you want, we can ask Hitesh to get back to you. But to my knowledge, it is not only subvention because it's a mix of everything. It's normal housing loans also.
Okay, and now the last question, your net worth last quarter reported to financial services business was 9,700 crores roughly, which in this quarter is 9,850, whereas the quarterly profit post-tax is around 400 crores. So what would be the difference? Is it the dividend which is given to the parent company?
That's right. That's right. The dividend is from the other segment.
Okay. Thank you, and all the best.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead. Nischint Chawathe from Kotak. Yes, sir, go ahead.
Hello. Yeah, hi. Just a couple of questions. The real estate loans that you disbursed this quarter were around 6,900 crores, and I guess you got repayments of around 3,800 crores. Can you broadly share as to how many loan accounts were these in each of the cases?
How many loan
Number of loan accounts.
I think that will
be difficult to give, but if you understand our ticket sizes, average ticket size is roughly like 250 to 300 crores. So you can arrive to the number. If you're looking for exact number, maybe we can get back to you.
But I think the more important, which is what I already mentioned, is that more than 50% came from the cash flows and the others actually refinanced us because that was the thesis which played out. When the project became less risky and we got paid off from the banks. I think that's more important, frankly, if I would look at it.
Sure. Just a clarification, your fee income you defer, right, over the tenure of the loan?
Sorry?
The fee income that you earn, you would defer over the tenure of the asset?
Yes, we defer it over the tenure of it.
That's it. On the home loan side, what would be the average yield like?
On the
home loan side, the retail home loan?
Yield. So, it is around 9.1%.
This is the IRR?
Yeah.
No, average yield is 9.1%.
Yeah.
Yeah. Again, on the retail side, you mentioned that you have an early warning program on the retail business. Now, the general market perception is that kind of retail home loans sort of, tends to be more commoditized business, especially in markets like Mumbai and all where asset quality is not really as much an issue. So maybe if you could, throw a little bit of light on what you are doing differently, and is it because of a different segment or what it is, maybe some color on that would be appreciated.
So let me answer it. In fact, what you just now said is true only to the salary sector segment. If you look at the self-employed, there are a lot of delinquencies everywhere today. And in fact, we haven't really entered the affordable in a big way, but I'm just saying that you'll be hearing, there's so many delinquencies in the affordable. The major reason is the underwriting. I always mentioned that it's always about the underwriting and the understanding of not only the projects, but also the customer. And that's what we are developing. Today, what has stood us in good stead has been our early warning and systems in wholesale, which is proprietary. And that is what last time on the call I did share with you, that even the Reserve Bank of India commented that they were surprised to see such strong processes on our platform, being such a young company. And this is what we have again developed, which I can't explain in detail because that's proprietary. And that's what I thought I'd share with you guys. So it's not really what you just now said, that there is no delinquency. There are very high levels of delinquencies when it comes to self-employed and affordable. And only it is the salary segment where the delinquencies are less. So obviously, this will help us in good stead going forward.
But for now, what is the proportion of self-employed or non-salaried in the portfolio?
As I mentioned already, that 54% of our are salaried and 46% is self-employed.
Sure. And
as of now, we have 0 NPA.
Yes. Just in terms of your overall loan book, under Index, all the other companies are classifying it into stage 1, 2, 3. Anything that you could share from your side on this one?
Index.
Sorry, can you please repeat your question? Slowly.
See, the overall loan book for NBFCs, and I think as you know, all the NBFCs have moved to Index this quarter. NBFCs have been kind of breaking up their book in terms of saying how much is in stage 1, stage 2, stage 3. So anything that you could share on this one?
So we have already moved into IndAS. Our accounts for our financial services business, effective FY17, have always been reported in the IndAS platform.
So, and how much would your loans be in stage 1 and stage 2?
Stage 1 and stage 2 loans.
So we'll come back to you with that.
Sure. And just one more request, if you could share the breakup of your portfolio, a rating-wise breakup of your portfolio, maybe from the next quarter or so.
Thanks for the feedback.
Yeah, thank you.
Thank you. The next question is from the line of Piran Engineer from Motilal Oswal Securities. Please go ahead.
Yeah, hi sir. Congrats on the good numbers. I had a couple of questions. Firstly, on our mezzanine book, which has been largely stable in the last few quarters. So is this a conscious decision or is it because of a lack of, good enough options in the market?
So it is not constant. I think, as I mentioned, definitely at the end of the day, we need to diversify because the risk-adjusted return today, even in project finance and senior debt, is almost the same. It gives you the same ROE. Exactly what we did in the real estate space. So while the numbers keep on growing, it's not that we are not going to. So let me clarify. We are not a bank who will only do project finance. We will continue to do mezzanine, especially if you have understood the business, we have gone deep. We will be doing end-to-end, and that's what differentiates us from the normal NBFCs and banking. So we will continue to do that.
That's fine, but if I see the numbers, a year back it was 8,500 crores, today it's 9,000, so it's largely stable. And the reason I'm asking is because, mezzanine is the entry point, for our relationship with the developer. And if that has been stable, how does this translate into growth in the future?
I think the number was not 8,500 crores. I think the number was only 3,500 crores.
Mezzanine?
The total book itself was 3,500 crores.
No, I'm not talking about corporate finance. I'm talking about mezzanine lending in real estate.
Okay.
So that has been largely stable. So the way I'm thinking about it is that, here if you haven't, added to your relationships over the last 1 year, how does that translate into growth in construction finance or other whatever products you have later down in the life cycle of your relationship over the next few years? That's my question, really.
Let me answer you in 2-3 points. First of all, in real estate, when do you need mezzanine funding? Largely, you need mezzanine funding when you do not have equity, when the real estate developer doesn't need equity. Again, if you take a step back, if you have seen in the last 4 years, what have we done? We have moved from category tier 2 developers to tier 1 developers. What is the need of a tier 1 developer? Tier 1 developer needs really equity, then he needs construction finance, and then he needs, suppose it's a commercial project, LRD, and then otherwise he needs housing finance. Now, if you really look at 3 years back, people were borrowing mezzanine only because they were not able to borrow or not able to get equity, and also they were tier 2. And that's what we have done. We have consciously moved to tier 1, and today with the combination of Ivanhoe platform and construction finance and housing finance, you see that you see the number coincidentally stable, but I'm coming to that also in a minute. So that is not something which a top tier developer normally takes. Coming to also the mezzanine funding, the number coincidentally is looking stable, but there is already a churn. So it's not that the same structured debt continues. It has got paid off. Maybe we have done some new. Again, it has got paid off and we have done some new. But conceptually, fundamentally in real estate, if you are backing the right developers, the developers who are in the 10% category, they will take your equity. Maybe for a short time, they'll convert it into structured debt and then really move on to construction finance. That's how the industry works.
Okay, so the way I understand it is that in tier 2, you had this competitive advantage of, providing mezzanine finance, which is not required by tier 1 developers.
I wouldn't say competitive advantage. Probably we didn't have, when
versus the HFCs.
Let me answer it very bluntly. When we were a one product company, no tier 1 developer will look at you. Today, we actually cater to the entire capital stack. So that time even I didn't have a choice.
Understood. Okay, I got you. And sir, another question is that, now what percentage of our loans are under the HFC subsidiary and how much is under the parent? And the reason I'm asking is, what sort of exposure norms are we restricted to as an HFC? I'm guessing as an NBFC, you're more free to have a larger proportion, say, locked up, exposed to one particular builder versus an HFC where there would be more, stricter such exposure norms. So, in that light, is it more actually of a disadvantage of being an HFC versus an NBFC? While I agree on the liability side and credit rating, you get better, you have an advantage.
Not really. Because, in fact, the capital adequacy ratio in HFC is, in fact, better than in the NBFC. It is 12% against 15%.
Agreed. But on exposure norms?
Having said that, we have been ready for HFC much before we integrated. So, in fact, it's not about the NHB norms or the RBI norms. I think the right word is prudent norms. And this is what we have been following, because at the end of the day, we have to look at the safety of the book and not just grow the book. I've been mentioning this in the second quarter today also, that we will ultimately, it's not about the growth only, it's about making a good book and also creating a good sizable fee income, which is syndication, and which is what in the last quarter we have actually started doing. And that will be the way forward. So we have already looked at it in a different way, if I am making sense to you, that we will follow the prudential norms, and we already have a club of like-minded NBFCs and other sovereign funds who would want to participate with us, which gives you a stable fee income quarter on quarter.
Okay, got it. And so just lastly on that, the Worli Seaface example. So, for example, if we funded one project of 10 apartments of 100 crores and, and that's what is going to sell, but then another builder comes up with 100 apartments and he kind of screws up the market and your project is undercut, what do you do then?
Oh, that's
what we've seen in Bombay, right?
Let me explain. What I meant was that in real estate, luxury and volumes don't go together. Let me give you this example. This is a live example, which I am not naming the two projects. None of them are funded by me. But please understand, you are a very high net worth customer, okay? You can afford and you want to, what does the high net worth individual want? He wants a limited gentry. He wants to be neighbors to only the people whom he relates to. Am I making sense? That's the fundamental flaw which developers made, and today if you ask them, they've realized that. Today, if I'm a big guy in life, I would rather pay 20 crores more, but I do not want to see some of the other, executives in other companies who are much lower to me, residing in the same complex. I definitely don't want it.
Yeah, I mean, okay, I wasn't really referring to luxury, but what I meant is that you fund a project based on its own merits, and that holds true until some other developer comes, right next to you, kind of gives a rate 10% below yours. So you don't have any control on what another builder will do. You have control over what your builder will do.
Let me answer this.
And that's what's actually happening in Mumbai, right? If I look out of my office.
Let me answer that.
Yeah.
So first and foremost, if you have been on the calls much before, we have actually given this example of how our underwriting is different. And we actually look at our underwriting with sales of our prices falling. We have been starting to do that 1.5 years ago when people didn't even realize that prices will fall. And we have been doing that. So as long as it is in a sensible range, it is fine. Now, I can assure you one thing, that nobody today in developer is able to bring down the price beyond the point. Why? Because the margins itself are not more than 15 to 18 or 20%. So today, those days are gone of 40% when a developer suddenly comes in and says, I'll go sell 20% lower. Those days are gone. So I don't think that's a risk. That's not a risk, I can tell you that today. But if somebody brings it 7-8%, I have no issues because my underwriting anyway takes into account 10 to 15% reduction.
Understood. Okay, got it. So thanks a lot for your time and all the best.
Operator, we'll take one question each now because looking at the time, it's already...
Sure, sir. Yeah. Sure, I'll make the necessary announcements. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the queue, we request you to please limit your questions up to one. Should you have a follow-up question, we request you to please rejoin the queue. We move to the next question from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, thank you for the opportunity. My question is, with respect to healthcare insights and analytics business, what is the plan of action to enhance the shareholder value here? Because this business occupies 20% of our capital employed and is a low growth and a low return on capital employed business. And on the contrary, we actually raised a slightly expensive equity money of about 7,000 crore. So there are about 5,500 crore of capital employed here. So if you could share your plan of action to create shareholder value.
So in this business, we are focused on trying to increase the top line as well as to improve profitability. What's happened in this business is that there's been a shift. Early on, people were looking at, as you know, we provide data and we provide insights to the whole healthcare industry. And there's been a change in the requirements of customers. Earlier, people used to we used to make a lot of money giving reports which had data which was done out of research. Experts that we had would give research reports to our customers. Now what's happened is gone towards real-world data. It's gone towards more analytics, and that's the transition that we've taken to. And we are seeing that there is some early signs of both top-line growth, and that's what you're seeing in this quarter, as well as now we are focusing on improving the profitability. So yes, it is an area of focus for the management to ensure this. And we are monitoring it closely, and we hope that you will see better results in the months to come.
So shareholder value creation will be a function of running the business and enhancing profitability, or will be a function of unlocking value here? Because our focus is always to do what is in the best interest of shareholders. At the moment, we feel that if we can increase top line and profitability, the value should go up significantly. If we find that in the future this is not happening, then we will go towards unlocking of the value. Okay. Thank you and all the best to you, sir. Thank you.
Thank you. The next question is from the line of Tejas Parekh from Citigroup. Please go ahead.
Hello.
Yeah.
Hello? Yeah, you can hear me?
Yes.
Yeah. Thanks for the opportunity. Can you talk a bit on your cost to income ratio? considering it has inched up slightly. I clearly understand that because of your housing finance launch, there would have been additional cost. But if you can just give us some guidance on your cost-to-income ratio for end of FY19. And secondly, is there any new product launches that it's planned for this year? New product launches.
Yeah, so let me answer on the cost income. It's not only housing finance. We also took a one-time cost. In fact, there will be one more cost in this quarter also of 25 crores in the first quarter, which was the merger cost related to the demerger. So that's why you see the cost income ratio going up. And of course, needless to say, we are ramping HFC. As you can see, even in the next 5 months, we'll be opening 4 more branches. So that cost income will definitely go because it's an investment into our businesses. But there was this one-time 25 crore hit, which I think there's some more coming also in this quarter, which will be the last. So that's the answer to cost income. In terms of products, I didn't understand. Were you talking about financial products or general products?
Financial products.
I already mentioned to you that our innovation will keep on happening. We will be unveiling even on the lending side some financial products, which right now I would not like to speak. But besides that, we have the equity platform with Ivanhoe, which we will announce a few deals. Plus, I already spoke about the asset aggregation platform. I also spoke about the REIT aggregation platform. And we are also looking at AIF, the Alternative Investment Fund, a fund model for equity investments into commercial assets and also non-real assets. So these are the various things which will be unveiled in the next 9 months to a year.
Got it. Thanks a lot.
Thank you. The next question is from the line of Dwanil Desai from Total Capital. Please go ahead.
Hi, sir. Good evening. My question is on the pharmaceutical side. I think if we look at last couple of years, we have made investment, in terms of inorganically acquiring companies with products. We are doing capex of $85 million. On that side, we have spent money on expanding our distribution channel on the OTC segment. So, I mean, we were in the 14 to 16% growth in last 5 years. So, with all this investment, do we see the trajectory changing to 20% range, in next 3 to 5 years? Is that a possibility?
Yeah, we are targeting that. We are looking at that as well as improvement in the EBITDA percentages. So we will go towards our margin should go between 20 to 25% overall.
Okay. And the growth trajectory may change to,
Yeah.
Okay. Thank you.
Thank you. The next question is from the line of Megha Haridamani from Pi Square Investments. Please go ahead.
2 questions. One on the real estate part. What are the macro risks that we still have after coming out of RERA and GST? Is there anything else that we see as a concern for this particular segment? And secondly, how do we intend to grow the consumer product business in India? What's the strategy on that front?
So I will talk on the real estate one without giving details because, again, that is something proprietary to us right now, which I didn't speak. There is, I think in the macro environment, one has to look at 2019 politics, election year. And without getting into details, we are actually proactively started working with our developers in guiding them how their borrowing and how their loan book should look like so that ultimately at the end of the day, no construction should stop in any of their projects. So that is something. As I said, we go beyond lending. We are actually the partners and solution providers and advisors to most of our developers. So I definitely cannot divulge what we are doing because that is proprietary to us. But that is the macroeconomic scenario which can play out negatively for real estate if things go wrong in the elections. I hope you have understood what I meant.
Correct.
Yeah. So coming to consumers.
So in the OTC consumer business, the strategy is very similar to what we did in the domestic formulations business earlier. What it is that we have invested in setting up a sales and distribution network. And now our whole strategy is to add new products to it. Some of these will be organically developed. and also some which we will do acquisition. So what happens in this is that if the infrastructure is set up of sales and distribution, then whatever you put into the mix just gives you a straight margin improvement. So that's what we are going to do.
So do we have any company that we are looking to acquire going forward in the near future?
Continuously, as you know, we keep looking at products, and at the appropriate time we will disclose it.
Okay, that's it. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take the last question from the line of Nirmal Bari from Samiksha Capital. Please go ahead. Nirmal Bari, your line is unmuted. Please go ahead with your question.
Yeah, thanks for taking my question. My question is if you can provide the breakup in housing finance loan book between LAP and home loans, as well as what percentage of these loans have been from developers whom we have initially financed out of the 385 odd developers that we have.
So LAP is only 5% of the loan book. Again, I want to qualify that the way we look at LAP is not only the security, and we actually look at the cash flows also, just as a point of view. So, but LAP is only 5% of the book, of the housing finance book. What was your second question?
What percentage of the loan book is from
our developers?
We have
So, if I take a step back, we had said it when we launched that this is a B2B2C platform, right? And we had said that we will be different. Our growth will come from this entire wholesale and retail talking together. And that has played out. So 80% of the housing loans today are through our developer relationships.
Yeah, but going forward, by engaging DSAs and through other means, we expect this to come down significantly as we...
I would answer it differently. The way we will be going, like for example, we are launching Nasik. Again there, where we have, as you know, the small construction finance division or the mid-market construction finance division embedded in housing finance. Again there today, while we are announcing that by the end of August we are launching housing finance in Nasik, I'm happy to share that the construction finance team who are looking at Tier 2 have already entered Nasik, have started seeding the market, getting to know which are the developers with whom we are working. So the model will remain the same. Now, whether it goes down to 70%, 60% or 80%, but our major businesses will always be this model, B2B2C.
Okay, thanks.
Thanks.
Thank you. Ladies and gentlemen, with this I now hand the conference over to Mr. Hitesh Chadha for closing comments. Over to you, sir.
Thanks everyone for joining the call. We're really sorry we could not take up a couple of more questions that were in the line. In case you have more questions, you can always reach out to us. Thank you.